Welcome, ladies and gentlemen, to realestateinvestormba.com. At Real Estate Investor MBA, we strive to provide valuable information from various experts within the business and real estate community, covering real-time market and economic information as well as curriculum-level material within various real estate investing niches. We aim to be relevant, straightforward, and forthcoming with actionable information for our community. And here's your hosts, Tejas Gosai and Jeremy Moyer.
Hello, welcome back to Real Estate Investor MBA for another great interview that we have lined up for you today. My name is Jeremy Moyer, and I'm one of your hosts. I am flying solo today as my co-host Tejas Gosai is not able to be here. Please check our website out at realestateinvestormba.com, where we have all interviews in video, audio, and written transcription formats. We're also available on several podcast platforms such as iTunes, Stitcher, Spotify, Google Podcasts, and TuneIn. Please subscribe and download all the past episodes to listen to them. A lot of great content has been shared by prior guests. If you think we're providing value, please give us a 5-star review, leave us some feedback. In doing so, more people will be able to find us and listen to the insight from our interview guests. Now for the show today, I'm excited to announce our guest, Syed Hasan. Syed is a partner at Ideal Management Group, a real estate investment firm located in Allentown, Pennsylvania. Ideal has focused on opportunistic multifamily and single-family purchases in Center City, Allentown. Syed has been investing in the Lehigh Valley market for the past 3 years. He has an entrepreneurial background with experience in commercial real estate and various other businesses. He has a master's degree in real estate development from NYU and has been investing in the real estate for the last 10 years. Syed, thank you for your time this afternoon.
No problem, Jeremy. Thank you for having me.
Absolutely. Can you tell our listeners a little bit more about yourself and also like with your background and entrepreneurial background in real estate, how did you end up choosing Center City, Allentown as one of your markets to invest in?
So those are actually that's probably two questions I could take 25 minutes to answer. But my entrepreneurial background, my father was always in different businesses, from anything from a travel agency in the 90s to a tattoo parlor on St. Mark's that he still owns today. I'm kind of like Tejas's background. We were brought up in business. So back in 2011, when I graduated college, I tried a lot of different businesses. I owned a Verizon store, but my main business has been contract manufacturing. So we do a lot of manufacturing in China and in other countries for companies and kind of make their product for them. And we're kind of like their initial distributor. So what most people don't realize, when products come into this country, they usually come in through a distributor or a importer, and the importer sells to a larger distribution network or a retailer. So I'm basically that guy. And then Center City, Allentown, it's actually a funny story because while I was working in commercial real estate, my long-term goal was always to be an owner, as most brokers have that, that dream. And, I tried to do it while I was working full-time at a very time-intensive brokerage, to say the least, in Manhattan. And I just couldn't find anything. I was going to Newark, I was going to Patterson, I was going to every market that was relatively close to me. I couldn't afford downtown Manhattan, but, so I was looking everywhere else. And funny enough, a friend of mine actually sent me a portfolio in Allentown. And I was just like, what the hell is Allentown? Like, I don't even know what it is. We took a drive out there. We took a look at the portfolio, liked the area. People were telling me, Allentown's real rough. It's a war zone. It's this and that. And, I was doing business in Newark and in Patterson. And I was just like, guys, you don't know what rough is if you're telling me that Allentown Center City is rough. We have very different perspectives of rough. I grew up in Jamaica, Queens. Like, we have very different ideas of what rough is. So, I came in here. We bought our first portfolio back in early 2018, and kind of hit the ground running from there. People always talk about like that snowball effect, and I wouldn't think I would be where I am today 3 years ago, but it's true. That first deal takes forever. It is a pain. Getting it financed was one of the worst experiences of my life. But after that, thankfully, it gets a lot easier.
I absolutely agree. It took, from my experience, the first property it took the longest, and then it just seemed like you just said, then it's like, oh, this is easy.
Yeah, exactly.
I guess in the 3 years that you've been buying here, what are you up to your portfolio in the Allentown area?
So as of today, I have 41 units, but we're just at the last legs of getting an appraisal. Appraisals right now have become a huge sticking point right now. They're just not coming in. People aren't even giving bids. So it's been a major issue, but we're under contract for another 19 units. We have a 9-unit that should have closed a week and a half ago, but we're still waiting on the appraisal. So soon enough, before the end of the year, we'll be at about 60 to 65 units.
Okay, all in Allentown proper, not Bethlehem or East?
All Center City, Allentown.
That's amazing. That's great. Congratulations.
Thank you.
When starting out, other than when you mentioned the financing was a pain, like what were some of other big challenges that you had to, I guess, work through? Just trying to think of different things that you can tell new investors as they're, trying to buy that first property or that second or third. What were some of the challenges that you had to work through?
Well, so even before Allentown, my main issue was finding a market that I really believed in. Like I just didn't know where. If you kind of look, if you're a New Yorker, you're looking, and I truly believe this, always look somewhere you can drive to, So if you're looking within like a 3-hour radius, I mean, there's a lot of options. There's Philly, there's Camden, there's parts of Connecticut, Long Island. You kind of look at each area and you're wondering why do these places exist, right? Like, what do they have to offer? What's the pros and cons of each market? And, Connecticut is good in some parts. Philly is great. I love Philly. I think that's actually would be my next market. But Allentown, just strategically made sense. It's right there. If you look at where your packages are coming from and flying into, they're flying into Easton. Right. So that's kind of why, I picked Allentown. And, everyone has their own math. Everyone kind of looks at what drives an area. What I tell people is you can find a great return technically anywhere, right? And you can find some tiny 5,000 people towns anywhere in this country and invest and get a great return technically. I don't believe in those markets personally because I don't know if they'll be there in 10 years. I'm looking at this as a 20-year hold, as a 30-year hold. So you have to believe that this town will exist. And arguably, when I was researching Allentown, it's already been through some of the worst that it could go through. Or just the Lehigh Valley in general, right? Like Bethlehem Steel goes out, like a lot of bad things have already happened and they're back. And I truly believe it's because the same reason why people say, New York might be dead right now. When you have a mass concentration of people, even if a couple people leave, the town's still going to be there.
Yeah.
I'm not saying rents are going to keep going up, but people are still going to live there and people are still going to be there because normally people don't like to move out of the area that they were, grow up in or whatever the case may be. So that's why, the hardest thing for beginning investors, I think, is picking an area, and then kind of narrowing down, okay, where do I want to buy within this area? And then kind of dealing with that analysis paralysis, right, that everyone talks about.
Exactly.
Because, you analyze a lot of deals and, there's nothing really wrong with that. I mean, listen, I analyze deals 10 a day probably. And you don't win much and you put out bids and that's just the name of the game. But, the good thing is once you start doing it more often, you kind of know what you're looking for and everyone's different, people are buying buildings for prices that I think are crazy, but it's always, everyone's money cost is different. Everyone's kind of outlook is a little bit different and, that's okay.
That's a great perspective. No, I agree with you. And you kind of touched a little bit on like some mindset right there in that answer, which a lot of our other investors, they highlight that as something that they needed to get right first before they really saw their businesses take off. That's great. So let's talk about it, maybe like a deal that went bad or didn't go a direction that you thought it was going to go after you bought it. Like, what were some learning lessons that you have internalized, that you've experienced, that you're like, I'm never going to do that again. This is what I'm putting into place to fix that, so that doesn't happen again.
Sure.
Yeah.
So one of the things has been, I mean, so many things have gone wrong, right? But all in relatively non-costly ways, I'd say. And you listen, every market is different, because I also invest in Long Island. I invest a little bit in North New Jersey. Every market is different. You have to learn every market. For someone learning a new area, I would say you're going to go through a lot of growing pains with your employees, that I did. My handymen were a problem. Finding, third-party vendors were hard. And that takes time. I had one, for example, during COVID, probably right before COVID started, I had a one-bedroom open up. It needed carpet, some flooring, some paint. I think it needed cabinets, and that's it. Okay, it should have taken a week and a half.
Mm-hmm.
That part of it was COVID, but it still took them like 4 months.
Wow.
And I lost rent for 4 months.
Yeah.
And fine, 2 months of that was COVID reasons. I that happens. You can't control that. But the other 2 months, I was just like, I've lost more money, by giving it to this guy just because he was relatively inexpensive than I would have went with someone else who could do it all soup to nuts.
Right.
So
yeah.
So now I, use another GC a lot of times when I need something done quick, and for bigger projects, just because you pay for it one way or another, either in lost time or in the price you're paying, right? So, you'd rather have it rented out quicker.
Cost relative, right?
Yeah, exactly. And then the other thing I would say is your assumptions. You don't, most people want to talk about assumptions all the time when they're analyzing deals. And the problem with those assumptions, your little Excel sheet is only as good as your assumptions, and your assumptions only get better with experience. So, when I first came in, I was like, oh, this is what it's going to cost me X per unit for maintenance and CapEx.
Mm-hmm.
And then it was like 50% more than that.
Mm-hmm.
And I don't like the fact that people are like, oh, let's do 10% of this and 5% of this, or even a straight number, because to be honest with you, everyone's, cost of maintenance and CapEx is different.
Mm-hmm.
Right. We are also a flipper over here in New York. So our materials cost are relatively cheaper than what most new guys would pay, coming into, renovating a unit. So you can't compare my cost to yours. And you can't go by percentages ever, because, let's say an $800 apartment, that's 10%. $80, a month isn't going to cover it.
Exactly.
So, let's say you have with this previous hurricane, we had multiple roofs, start leaking water. We had one full replacement. So that whole building technically isn't making money this year. Mm-hmm. And so these are some of the numbers we've adjusted, in terms of our analysis of the properties. I mean, thankfully, we got these properties for so cheap that you're still cash flowing. Mm-hmm. But that's why I'm very happy on some properties that I've seen transact at very high prices. I'm like, oh, I should have pushed it a little bit higher. But then I'm looking at my numbers for my assumptions in terms of, my CapEx, my maintenance. And I'm like, nah, like I would have been losing money if this is what happened in that building.
Right.
Because you just can't afford to pay that.
Right. And then at some point you kind of have to start looking at it from like a portfolio level right?
Yeah.
A number of properties.
Yeah. So now I look at it at a portfolio level, and I actually do tell most people, being a landlord of one building is one of the worst things you can do. It is a horrible idea. Right. I hate it. I learned the rental business from my father, and he had one rental in Deer Park, Long Island. And it's just a pain because, you have, and one house, especially single family houses, I don't think people realize the CapEx that's required and the maintenance that's required on a single family, just because it's triple the square footage. It's just simple math. It's going to cost you more. But it was a pain for that. My father, when I was getting into rentals, was like, oh, are you sure you want to do that? And then, now he's like, yeah, it was a great idea. But, it's a lot better when you have, 40 tenants and, one doesn't pay, whatever, can deal with that. When you have one and one doesn't pay, you got some issues.
Yeah.
It's the same reason why I don't buy in Bethlehem. I don't buy in Easton. And it's not only do I believe in Center City, but I need a mass concentration in one area first, and then I can look later to the other areas. I'm trying to get to a couple hundred units in Center City first, and then I can bother with Southside, Bethlehem, and Easton.
That makes sense. Okay. So do you manage the properties yourself, or do you have
Yes.
a company? You do. Okay.
Yeah.
So you kind of touched based upon that answer. The analysis by paralysis, I think, was the prior answer you mentioned. For new investors, I guess that's related to this question. They're just creating those spreadsheets. They're creating their buy box. They're creating their criteria, and they're going off of what they might want to achieve, and they have that goal in mind. With the market the way it is right now, like, is the advice just go buy something, or is it put that underwriting criteria in place and just stick to it? Or it's a tough market right now. I think for a new investor, not really understanding some of what happens after you buy the property. Yeah.
So I will say, my partner always says this, it's very easy to buy, right? Sure. Once you've bought, you can spend all the money you have in the world, right? Like, it's very easy to buy. So right now, I actually tell people all the time that have come to me for advice on flipping, on buy and holds. It's a very hard time to kind of enter the market. Mm-hmm. We have, in most markets that's not New York City, a COVID bump. Prices are higher than ever. Mm-hmm. I tell everyone we're in like a weird limbo in the market that I've only seen back in 2014. In 2014, we had the same thing happen, was that prices were at all-time highs and buyers were just like, wait, maybe we should wait. Like, prices seem too high, it's going to come down. And then you have, the sellers being like, like, of course my thing is worth X, like it was, X minus 20% a year ago, but now it's worth this.
Sure.
So, and right now you have the issue is that sellers see that there's no supply in the market and they think they could bump it up even further. Mm-hmm. But then you have major issues in the purchasing in that these properties won't appraise, for those numbers, right? And multiple properties haven't, that I know of, that have transacted. But the good thing is rents have been increasing so much that it's kind of unfathomable to me. Like, I had a 4-bedroom, 1-bedroom house rent out for $1,250. My neighbor had his rent out for $1,400.
Wow.
In Center City, Allentown. And I don't think his rent is really like sustainable. Mine is just a little bit more than what market used to be. Yeah. But rents are going up. Now, I do think that's because of COVID. There's no rentals on the market right now, just because there's no eviction going on. Everyone's just staying put. No one's moving. Yeah. So I think that will change. I think prices will come down. We are all paying more than what we used to. My first portfolio, I bought at $42,000 a unit. Now my latest building that I'm buying is at $60,000 a unit. Mm-hmm. So obviously a substantial increase. But some of this stuff that's listed for $70,000, $80,000 a unit for a 3-unit, they never transact. And that's what makes me feel better sometimes, because I'm like, am I messing up here? Like, and they don't usually transact. And a lot of people look at the very high comps, the $95,000 a unit, the $100,000 a unit, and think that's their building and like, oh, I can get it to that. But unfortunately, I know some of the sellers of those buildings, and they've renovated those buildings and got high rents in place. So you can't compare that to a value add building. Yeah. So for most new people, what I would say is it depends how you're buying the property. If you're like a true investor like me, you start up a company, you're putting 25% down on commercial debt. You're going that route to actually build a company. you just need to keep, chugging along, pushing for deals. And if your Excel sheet you think is right, then stick to it.
Mhm.
Now, if you're a, house hacker, or if you're, just buying, your goal is never to have 200 units or 400 units. Your goal is to have 10. Then you have a time, cost of capital, right? You're like, okay, like time is actually costing me more because they also have access to much cheaper debt than I do, right? So they can go get something for 5% down, 10% down, So for them, if they buy a 3-unit, a 4-unit, they live in one of the units or not, it's a different math for them, right?
Yeah.
Exactly. Because for them, if they buy a 7 cap or a 7.5 cap, and are borrowing at 3%, that's okay. The spread is there.
Yep.
For me, if I'm borrowing at 4.25, I need to buy it at 8.5 then, or 8.25.
Yep.
So it depends who your buyer is. And I do think right now we are in a weird lull in the market. Transaction volume's down. So you're kind of seeing it. We're at that stalemate, and you will see some stuff transact. And, usually at all times, even when the market like plummets, what you always see is price per square foot actually go up for certain deals. And the reason why you see that is there's a flight to quality, and people will still buy good buildings for a premium because you got to remember, people also have to do something with their money, and doing nothing is also a decision, So if you have money sitting around, you also have to make that decision. Hey, where do I put it?
I love that. That's great. Doing nothing is also a decision. That's very true. The opportunity cost, right? Doing nothing. That's awesome. So just going a little different direction, can you just kind of give the listeners an idea of some recent deals that you've done? Like, where did you find it? Was it listed? Was it off market? What did you buy it for? How much you rehabbed it for? What are you renting it for? Just to kind of get ideas of the numbers.
Sure. So people always tell me how I source. Now I tell them I don't know where my next deal is going to come from, but I know it's going to come. Even in just Allentown, I have gotten deals from wholesalers, from agents, from the MLS, from for sale by owner on Zillow, from every which way you can imagine. You just have to be active, and that's the most important thing in the market. You just have to be active and you'll get a deal. Like I truly believe that, but you have to put the time in. So, I've had a variety of deals. The funniest deal, and what I mean by being active, and it's actually not a huge deal, was a small purchase. I bought a small deal on Oak Street in a horrible little alley in Allentown. I was actually at the building department paying fines and fees and whatever else. And this is what I mean by being active. If I had a PM, I wouldn't be doing this, and I would have never gotten this deal. I see a owner, yelling at the building department, and arguing with them, and them telling them they don't have funds to help him and whatever the else may be. So I was like, okay, let me tell my partner, okay, wait, I'm going to talk to this guy. So I talked to him, and I'm like, hey, like, you're having issues here, like, what's wrong, and let me see if I can help you out, or hey, maybe I'll buy it. So I approach him, we're talking, and what happens is his tenant was stealing electricity from PPL. They like messed with the meter. So what PPL does then is they take off the meter, right? And then now the building has no electricity. So then the building department condemned the building because you can't have no electricity and no running heat in the winter, right? So this guy's just like, crap, I don't know what to do. He doesn't have the money to kind of fix it himself. It was thousands of dollars of electrical work. So, we right there and then we were like, okay, we'll buy the property from you. What do you owe on it? How much do you want? Let's talk and let's go over there and see it. So we go over there, we walk the property, pretty decent condition. We end up buying it a month and a half later in cash. We put in about $10,000. It appraised for 75. We got all our money back. And we got it rented out for $12.25.
What'd you buy it for?
41.
That's awesome.
So we got our 51 back.
Yeah.
We got it rented. We're cash flowing about $360 a month on it. It was a home run deal, and we did it in under 6 months. So we didn't even have to do a deal with seasoning on that one, because I didn't mention it before, but always build a relationship with your bankers, and all the rules are guidelines, and you can usually, if you're doing a lot of business with them, work with them, and they're there to lend and help you out as well.
Now, do you use banks in the area here, or is it?
Yeah.
Okay.
Well, I use both. So I do use local banks. I also use some North New Jersey banks as well. But my local bank is actually First Keystone. They're great to work with. I use Mike Santiago over there, and he's great. But like I said, it's a relationship business, and you got to know him. I speak to Mike every day, so that's very important.
Right. So do most of your deals, I do agree with you on that, the banker conversations and relationships. I guess, is that just an example of the type of deal that you try to buy, like try to cash out everything on a refi? Are you able to achieve that the majority of the time?
Well, so that property was actually our first single family. And the only reason we bought it was because we were just like, wow, this is cheap. Like, let's go. Yeah. After that, we ended up buying 2 more singles, one for 50, one for 44. Both are rented now for $1,250. So, it's like a 3% return, of a rent to purchase price ratio, right? Yeah. We don't look to take out all our money on all our deals. We do on certain properties, on the singles we do, because we're usually buying those in full cash, because it's such a low purchase price. We're not going to deal with getting a bank involved and all that. Yeah. It's just a hassle. On the bigger stuff, we do try to get out. What we try to get out is max our equity, right? So like we do try to get 100% of that out. Most of the time it does work. Sometimes it doesn't. But if we believe in the property or the area, we'll do that. We're about to buy another property right now it's a smaller building. It's 2 units, but we don't think it will, we'll be able to get all our money out. But, we'll have relatively little money in, and it's a long-term hold. So we're okay with that. So it really depends on the deal. On some of the larger deals, it's actually a lot easier to get your money out because, on a 5, 6, 7 unit, you're only going by income approach. Right. And since you're pushing the income up so much high, they usually do appraise. Mm-hmm. So you kind of get lucky in that sense. The 3 units are a little harder, right? Because you're going to do both. You're going to do a sales approach and an income approach. And the sales approach is actually what's hurting you. These things don't sell that high usually. Right. So it really depends on the specific deal, but me and my partner are very risk averse. So, we try we never take out full leverage. And, we don't really mind leaving money in deals. And we actually do a lot of our purchases in cash. So out of the first 41 units, only 18 of them have debt on them. All the rest, now 19 have debt on them. So, we buy a lot of stuff in cash because people don't realize how much money you save by buying in cash. You're not paying for appraisals twice. You're not, paying a lot of these fees twice, and then people forget there's a prepayment penalty usually for most banks. Right. So, you save money that way and you save a significant sum. So it becomes easier later to do that cash out refi and take out all your money. So it really just depends on the deal. But yeah, we do focus on everyone wants to get most of their money back so you can buy more deals.
Absolutely. Keep turning it, right?
Yeah, exactly.
So if you touched based upon the cash, so is that your own cash? Is it OPM, other people's money that you're borrowing? Is how you structure that?
Almost all of it is our own funds. We do take some funds from people depending on the investment, but we try not to. Me and my partner do not actually give anyone equity. So our company is only me and him. We refuse to give equity, and we've had many approaches in our business to get OPM, but more on the LP side, right? So they want to be the LP, they want to get a windfall and all that. We refuse, just plain and simply. The main reason being is you end up making sure, you make double the money that we'll make, but you're doing 5 times the work. You know, and that's the hard part, right? Like we did it out. We had some investors that offered a lot of money to us, and we did the math out to like, hey, we would need to own like 1,000 units.
Wow.
To make double the money of us owning 200 units. You know, and don't get me wrong, it's still more money, but you know, I'm not too greedy, you know, so it's like I have a number that I want to hit, you know, but I don't want to answer to anyone else in terms of equity, you know. So what we structure on certain deals, if we need the cash, is debt-based, you know, a debt-based structure. So, you know, they'll take a 95%, you know, lien on the property, you know, and we're already buying it under market usually. So they're in a safe position, we're in a safe position, but it's short term. It's usually for a year or less, and we're going to cash out and get their money back out. They're happy, we're happy. And a lot of our investors, and what I tell people who want to, you know, raise money eventually is, first of all, go within your own networks. You know, it's always the best and easiest. And next, go for the working professionals, right? You know, the doctor, lawyer, accountant, they don't have time for this. You know, they're making money in what they do. You know, it's very hard to get money from a business owner because they're like, I'll do it myself. Right. You know, so you have to kind of focus on those people because you're actually bringing a value add to them too. You know, you're doing them a service, you're doing yourself a service. You know, it's a symbiotic relationship there. So those are kind of the people you should always just focus on. Because they have high net worths, they have good income, and they're kind of, you know, okay with that because you're still giving them more money than what the stock market usually returns, you know? So, you know, and it's just a diversification of their assets as well.
Makes total sense. Have you had to raise any capital debt structure since COVID?
No, I haven't.
Okay. I was just curious if you had and how those conversations went with risk mitigation and whatnot. So going to when you're looking at evaluating a building, like what you named a few metrics that you look at, like what kind of a quick sniff test on like this makes sense to go into further, and then like what are those next level due diligence tactics do you guys employ?
So the first thing I do is just a simple price per unit.
Okay.
You know, and you can only do that if you know a market very well.
Yep.
Right. So, and by market, I mean like a zip code. So like I only look at 18102.
Right.
So if I see something listed for 85,000 a unit, 90,000 a unit, already off the top, I know I'm not buying it.
Exactly.
Right. Like it's just not going to happen. Even if it's a good deal, even if it's it's an 8 cap and, you know, I can make money on it, I can't cash out on that deal.
Yeah.
Right. What's it going to appraise for? 90 a unit, maybe? Like there's no value add there. You know, the value is already done. So, you know, I used to work in New York City commercial real estate, and, you know, there's a value add product and then there's finished product. There's finished product buyers and there's value add product buyers, right? I'm never in the finished product buyer, you know, and that's okay. For us to do value add, there needs to be finished product buyers.
Sure.
Right?
Absolutely.
So the first right off the top, price per unit is relatively an easy one to kind of do. Then the next one I look at is the unit breakdown and the square footage, right? So for example, you know, you list up a 3 unit for 225, but is it a 1,800 square foot 3 unit or a 3,000 square foot 3 unit, right? So if it's 70,000 unit, but it's 3,000 square feet or, you know, very large, okay, I'll take another look at it. But if I see, you know, right off, you know, you can go on the county assessment, it's 1,900 square feet. I don't care where it is in 18102. I'm not paying, you know, 240 grand for it because it's never going to cash flow the way I want it. So that's, you know, the first 2 things I'll kind of look at. Then after that, you know, I'll look at, and I tell this to everyone, the only things you need to see in a building really is the basement and the roof, right? So figure out the utility breakdown. I love when brokers and wholesalers actually know that already. Tell me what the utilities are, how it's broken down. And then I'll run through a quick Excel sheet. My Excel sheet is a 1-pager. You know, it's very simple. I'm just listing out my income, my expenses, what my cost of capital is, and what am I returning per unit and a percentage basis, on existing, and then on my cash out refi.
Mm-hmm.
So, I want to be at least, 225 to 250 plus, and I want to be,
Per unit.
initially, per unit, at the minimum.
Yeah.
And depends on the building though. Like on a single fam, 300 plus.
Yep.
Definitely.
Yep.
On larger buildings, in the low to mid twos. And if I can get to 200 and above when I cash out all my equity and I turn the building and raise rents and everything, perfect.
Yeah.
So that's kind of my metric. But one of the most important things I think is, for me at least, is can I cash out refi this? What will it appraise at? And will I be able to take out my money? Because if I can't take out my money and my money's just stuck, well, then it's a different calculation. And I might buy the building because I believe in the area, or you gave me a building on Walnut or on Hamilton right downtown, maybe I'd buy it. But if it's a tertiary area, it's up near 22, maybe I won't. So it really depends on the location as well. That's when all the other variables kind of come into account.
That's great. It's not, I like what you just said. Not, you have your criteria, but it's not, if it's just a little bit outside of this box, it's not going to, there's other variables that can impact.
Yeah, 100%.
Makes sense. So what's themed opportunities, that you might see, or even, well, no one has a crystal ball, so predicting, but over the next 5 years or whatnot, do you see just maybe a little bit of a bump at some point over the next couple of years and then continue climbing? Kind of what type of product? Is it that small multifamily, maybe up to 20, 40 unit that's available here in the Allentown area, or even maybe surrounding areas once you build up to a certain level? What do you what kind of do you see, and what do you think might play out
in terms of the local market or area, or just real estate?
Yeah, local market with real estate. Yeah.
Okay. So the local market, I think one of the biggest opportunities is its geographical location, right? I personally, just because everyone's going remote and COVID and all this, I don't think people are just going to be working from home, forever, and people are going to move out to the middle of Arkansas and cheap places, and that's not going to happen, right? What people forget is all the markets that are booming right now are all suburbs of major cities.
Very true.
Right? Long Island prices are going insane. Westchester, North New Jersey, Lehigh Valley, they're all going insane, but they're all near major cities, right? We've kind of lost that people just want to, be really far from work and all this, because pre-COVID, only 5% of US employees were full-time work from home, So post-COVID, will that change? Sure. Do I believe, a Facebook, when they say 50% of people are going remote? No, because then after they do that, they go lease 800,000 square feet in New York City at the new building that they're building right near Penn Station. So it's their actions speak differently than what they're saying, So what I think will happen is, people will be working from home more, I do agree with that. I don't think people need to be in the office 5 days a week, 6 days a week. I don't think that's reasonable. If it goes to, 2-3 days in the office, I think that's something reasonable. For, the Lehigh Valley, I think, since it's so close to Philadelphia and North New Jersey and New York City, you're going to have Amazon growing there. You're going to have a lot of e-commerce growing here. And, you can just see it by the trucking in the area, right? So I think that's going to be one of the key factors of the Lehigh Valley's growth. And, any jobs that kind of get, not removed from New York City or North New Jersey, what I personally don't understand is North New Jersey is very expensive, right? Relatively. New York City at least has a reason to be that expensive. It's Manhattan, right? Okay, I'm in a location, right? The amount of people I see, walking down any street in Manhattan right now is still more than I see in any, smaller city in America, right? So it's still going to be something. But, and I've had a lot of tenants also come from North New Jersey. It's hey, they're paying double the rent. Their businesses are probably paying double the rent. If you're an office space in North New Jersey or even a little bit west, why not move to Lehigh Valley?
Right.
Or even if you're working in Manhattan, you can commute 2 days a week, into the city if you need to.
Exactly.
So I only see good things for the Valley, and especially Allentown. I think, Allentown I've focused on because I've seen it gentrify. It definitely has a lot of working class people, but I see their incomes, when they're coming in now, and it's higher than ever, right? Like they're making decent money, they're able to pay higher rents, and it's interesting to see local Allentown residents getting kind of gentrified out, right? Because other people are moving in, and I think that'll continue for better for worse. And people like to be near a big city. They want the restaurants, they want the art, they want all that a city has to offer. And I think Allentown will be part of that as the biggest city in the Lehigh Valley. So I think really only good things. And honestly, real estate wise, what people forget to look at is not what prices, how they're tracking, track how rents are tracking, right? Like in overall trends, that's what pushes value, right? So people look at like New York City office, like, why has it gotten so expensive? Why are these buildings worth hundreds of millions of dollars? Well, that's because look at where suburban office rental rates were 20 years ago, and look where city office rates were 20 years ago, and it's a massive difference in the two. So people always forget it's the rent is what pushes value, right? So if rents are going up, it's a very good thing for the market. And I do think there will be a bump. I think there has to be. We've been on a good run, yeah, to say the least. But I don't think it'll be a horrible thing. I think it'll be a good thing, a reawakening for the markets and for the investors. I think the last 5-6 years has been a big push, by the Grant Cardones of the world and the Clayton Morrises and all these guys that kind of are pushing it to everyone, and it's not a bad thing. I do think, unfortunately, some people will get burned in their purchases, and I've seen it. But they'll learn, and hopefully they come back and can participate in the good parts of real estate. You just have to be very disciplined and kind of go from there. But I do think we'll have a bump. Maybe, I don't have a crystal ball, but maybe a year from now, maybe 6 months from now. What I tell people is, like, I'm not a genius. I don't know where prices are going, but if you invest long term, it doesn't matter.
There you go.
Right? Like me personally, I don't care what my buildings are worth in 20 years, 25 years, because at that point, the buildings are paid off. They're generating rent, and people don't realize that even if you sell your property for the same price you purchased it at, you've still made like, depending on the building, 8-10% on your money probably.
Right.
So if that's your worst case, okay, that's fine. I think what people really should focus on is maintaining your building. Don't let your building go to disrepair, because that's when you lose money in real estate.
Right. That's great perspective. That's awesome, man. Thank you so much.
No
problem. This is the last question, and it's the same one for everybody that we have on that's local. So what's your favorite restaurant here in the Lehigh Valley?
So this is something as a New Yorker I've struggled with. Come to the food. I've been very disappointed, to say the least. But the one shining, the light at the end of the tunnel has been a Hummus House.
Hummus.
Yeah, that place is amazing. Yeah, I would put it up against any of the spots I go to in New York City. Yeah. And I'm very disappointed when they're always closed on Mondays.
It's so funny. We had another guest on earlier. This was like a couple months ago. He used to live in New York and work in New York. And now he's here local in Bethlehem. But that was one of his. He gave 2 answers, and that was one of his answers.
It's amazing. Yeah. But if you have a list, just send it my way, and I'll start trying all of them.
There you go. So in closing, Syed, how can listeners learn more about like what you're doing, following on social media? How do they get in touch with you? If you want to provide any information.
Sure. They can all just kind of shoot me an email. I'm not big on social media, but just shoot me an email. My email, you have it, is Hasan, Hasan 546 @gmail.com.
Okay.
And I'm always happy to help any newbies that are starting out.
Sounds great. We'll also put that in the show notes when we transcribe everything. So Syed, thank you so much for your time today. Again, to our listeners, if you see us providing value, please leave us a 5-star rating on iTunes. Also provide any feedback that you like, what you like about the show. Everyone, this is Syed Hasan with Ideal Management Group. I'm Jeremy Moyer with the Real Estate Investor MBA. Take care. Thanks.
Thank you.